Hello everyone, and welcome to the Marquette Associates Retirement Basics Target Date Funds webinar. My name is Colleen Flannery, a research analyst here at Marquette, and I will be walking us through this webinar with the objective of arming you with the knowledge needed to make informed decisions regarding target date funds on behalf of your participant base. Our agenda for today will be to cover what target date funds are, how they are structured and differentiated. We'll touch on some of the key trends within the target date fund industry. And lastly, we'll take a look at how these funds are evaluated and monitored. So what is a target date fund? A target date fund is an all-in-one diversified investment selected by a participant based on his or her estimated year of retirement. Typically, target date funds invest across stocks, bonds, and sometimes alternatives like real estate, with a goal of achieving a target level of diversification throughout the life of the participant. Target date funds follow a glide path structure, which means they become more conservatively allocated as the participant nears retirement. For example, if a 35-year-old expects to retire in about 30 years, we'd expect them to select the 2050 target date fund. Since the fund would systematically decrease equity and thus risk exposure over time, the participant would be left with an age-appropriate portfolio at the time of retirement, even if the participant were to, let's say, set and forget it. Where target date funds differ are on the usage of to-retirement versus through-retirement schemes, the various types of asset classes within the fund, and whether they utilize active or passive management. First, let's cover target date funds from a historical perspective. Target date funds have gained an overwhelming adoption in participant-directed retirement plans over the last decade. Adoption has grown in major part due to the Pension Protection Act, which was passed in 2006. This legislation allowed target date funds to become one of the qualified default investment alternatives, or QDIA, in retirement plans. This means that employer and/or participant contributions would default into a target date fund or another QDIA option if the participant does not make an alternative selection. Target date funds explicitly satisfy 3 of the 4 requirements to be a QDIA within ERISA-governed plans. So, as fiduciaries, plan sponsors can aid participants by using plan design to guide assets into age-appropriate investments while also enjoying certain protections under the law. Target date funds seek to create balance between human and financial capital. Shown here, financial capital for a younger participant just entering the workforce is nearly zero, as they have not had enough time to accumulate substantial savings. However, human capital is quite large, as this represents a participant's earnings potential. It can be thought of as the present value of future earnings. Human and financial capital together comprise total wealth. Human capital is thought of as more bond-like in nature, receiving regular coupons in the form of a paycheck, while financial capital is current savings which are free to invest. At the beginning of a career, nearly all wealth is human capital, which is why nearly all financial capital should be invested in equities or risk-seeking assets to achieve an appropriate total wealth portfolio and balance out all that bond-like human capital. As human capital decreases, though, financial capital's investments should become more conservative. In other words, to compensate for the amount by which these theoretical bonds are decreasing, financial capital should incrementally be transitioned from risk-seeking assets to more diversifying assets, like bonds. Moving on to the structure of target date funds, you may have heard them referred to as either to retirement or through retirement. This simply describes whether the funds have shifting asset class exposures to or through the retirement date. On the left, we show the glide path or asset allocation of a to fund, and as you can see, the equity exposure does not change after retirement age. This is typically due to the belief that human capital is no longer changing, so neither should the portfolio. On the right, we have a through fund, which continues to adjust its equity exposure through retirement. Not all through funds are the same in that some may adjust through the age of 70 and some beyond 80. The continued adjustment is sometimes due to the belief that the modern worker is less likely to completely halt working at age 65 and instead work beyond or pick up some part-time work. We do not hold a belief that one is better than the other, and believe the right choice is determined by participant pool characteristics. Going on under the hood of target date funds, it is important to analyze the equity and fixed income exposures at the sub-asset class level. Here, we show two hypothetical managers that have the same equity and fixed income exposures. However, upon closer review, we can see that they have considerably different risk profiles at the sub-asset class level. Manager A manages a riskier portfolio with exposures to riskier markets like small cap and emerging markets equity, and higher credit risks in fixed income. The proportions of these risk sources also change, whereas Manager B retains the same proportions to all exposures throughout the life of the series. Again, here, one is not necessarily better than the other, as the right fit is determined by the uniqueness of each participant pool. To further highlight this, the chart seen here illustrates the differences in risk-return profile between potential target date funds, which is not immediately apparent if we were to look at the glide path alone. Examining the divergence and results from multiple target date offerings, we find that there can be a meaningful difference in the level of risk designed for the same participant cohort. Accordingly, plan sponsors may be better informed regarding the suitability of a given fund for their participant population after reviewing risk and return profiles. Wrapping up the structure of target date funds, the impact of investment management fees cannot be ignored. Fee awareness has increased among participants and plan sponsors, leading to fee compression in the target date fund space, which coincides with greater utilization of passive investment across the broader investment landscape. Indeed, all else equal, lower fees are preferable, and plan sponsors should work with their consultants to verify that overall fees are competitive. Nevertheless, it is important to recognize that target date funds still make active decisions as it relates to the primary differentiators of portfolio risk, namely the glide path and underlying asset mix. Thus, plan sponsors should take care to consider all factors responsible for net of fees performance. While no one-size-fits-all solution can perfectly fit the unique needs of all participants, the benefits of target date funds relative to less dynamic investments outweigh any shortcomings for most investors. Target date funds are easy to use in that a participant only needs to make one investment selection, or possibly none at all, to achieve sufficient diversification. They also leverage the expertise of the fund manager to present more diversified, age-appropriate, and risk-adjusted asset allocations than many participants would manage to construct when left to their own devices. By rendering the investment choice less complex and less intimidating, target date funds can improve outcomes for participants who may otherwise be reticent to contribute more to the plan or monitor their own retirement readiness. Nevertheless, there are some challenges that target date funds are unable to address. Particularly, when nearing retirement, savings levels and spending goals become increasingly diverse, and ownership of assets outside the plan may also affect an individual's risk tolerance. Furthermore, some target date funds face challenges incorporating asset classes that cannot be easily valued on a daily basis, like real estate, hedge funds, or private equity. For these reasons, we expect continued innovation in the space, as target date funds continue to be the most used option as new participants enter the workforce. Some interesting trends are apparent in the usage of target date funds. First is the tendency of us women to be more trusting of professionally managed options, the bulk of which are target date funds. Men, on the other hand, tend to be more do-it-yourselfers. This trend holds whether enrollment is voluntary or automatic. As we alluded to earlier, it is no surprise that as target date fund adoption has grown, their assets as a proportion of plan assets have grown as well, hitting 42% in 2018. Target date funds have become an overwhelming favorite for the default choice at 96%, and of participants holding only one fund in their DC plan, 87% were holding a target date fund. This is a good thing compared to a participant only holding, let's say, one equity or one bond fund. And to the right, we also see the greatest adoption are by younger participants. This isn't surprising, as more younger participants have been defaulted into the funds in recent years. One of the things consultants like us tend to worry about is that in market downturns, the participant might get nervous and pull into cash. What we've seen from participants invested in target date funds, though, is that they tend to remain invested through the downturn and are then able to reap the benefits during the often sharp market rebound. For example, if we look at some of the more recent volatility in 2018, less than 1% of participants made trades during weeks of heightened market movement. Behaviorally, the simplicity of an all-in-one professionally managed product allows users to be less active in their retirement, which, as long-term investors, we see as a good thing. As target date funds have gained popularity, data evaluators like S&P and Morningstar have created peer group indices to help plan sponsors evaluate and monitor performance of target date offerings. The S&P index is based on peer group asset class weight averages with both to and through versions, and the Morningstar index is built on proprietary risk-based research and has a conservative, moderate, and growth variant. Peer rankings can be helpful in evaluation, as consistent underperformance may be a red flag. It is worth pointing out that each target date fund is in essence its own unique portfolio, so an appropriate benchmark is critical if it is to be held to that standard. For example, a 2060 fund with 95% equity weight shouldn't be compared against a benchmark with 85% equity, as it will likely always outperform in up markets. If you have a passive fund, the relative performance to the benchmark becomes less meaningful and instead speaks to asset allocation decisions. Conversely, if you have an active fund, relative performance may speak to either manager out or underperformance or asset allocation decisions. There are additionally hybrid and blended options which are partly passive and partly active, which can help reduce fees but allow for some manager outperformance. Ultimately, the indices can provide guidance, but deeper diligence is needed to understand performance drivers. This concludes our overview of target date funds. We hope you find this useful in any future conversations regarding target date assets, and going forward, please contact your consultant if you want more information on what was presented today. Rewatch or share this webinar and make sure to register for research email alerts on the Marquette website. Thank you everyone for watching and have a good rest of your day.